So I just wanted to do a little bit of kind of an article here for you. Um, this is pretty much the Barndominium financing revolution by yours truly, Levi Aberly, the Fortified Man. So the shift that no one saw coming. 5 years ago, if you walked into a bank and said you wanted to finance a Barndominium, you already knew what was coming. No, not let me check with underwriting, not we might be able to work something out, just no. The loan officer would smile politely, maybe tilt their head a little, and explain that barndominiums don't fit their lending guidelines, that appraisals are too difficult, that comparable sales don't exist, that the collateral risk is too high. And for years, that was the end of the conversation. Okay. But something started to shift quietly at first, then all at once. Today, we're standing in the middle of a full-scale revolution in how the mortgage and lending industry views barndominiums and post-frame construction. I'm not talking about a slight warming. I'm talking about a complete reversal from categorical rejection to active pursuit. So this article is going to break down exactly how that happens, where we are right now and where this is headed, because the trajectory is clear to anyone paying attention. Banks are not just going to accept barndominium financing. They're going to compete for it, just like the traditional mortgage system. The evolution, so basically the timeline of the financing landscape, to understand where we were going, you have to understand where we came from. That financing landscape for barndominiums has moved through distinct phases, and which ones built on the last. The phase one. During this era, barndominiums are virtually impossible to the lending industry. Banks categorize them as agricultural structures, pool buildings, outbuildings, anything but legitimate residential dwellings. Appraisers had no framework, underwriters had no guidelines, loan officers had no product to offer, even if they wanted to. The handful of barndos being built during this period were financed almost exclusively through cash, personal savings, informal private lending. Some owners used home equity lines from existing properties. Some used agricultural loans that technically weren't designed for residential use. Okay. The mortgage from the industry was clear. We don't know what this is, so we're not touching it. Phase two. This is when things started to change, not from the top down, but from the ground up. Small community banks and credit unions in rural markets started making exceptions. These were lenders who knew their communities. They could see with their own eyes that the well-built barndominium was not a metal shed. It was a legitimate home that people wanted to live in. These local lenders started writing construction loans for barndominiums on a case-by-case basis. No standardized guidelines, no formal programs, just individual bankers making individual decisions based on the borrower, the builder, and the project. That's the way mortgages traditionally have been before they went to underwriting. So it was slow, it was inconsistent, but it proved something critical. These loans could perform. The borrowers paid, the homes held value, and the collateral was sound. Phase three, the pandemic changed everything for housing. Material costs spiked big time. Labor shortages hit every market. Build times on traditional homes stretched to absurd lengths. Suddenly, the advantages of post-frame construction were impossible to ignore. Faster build times, more efficient material usage, less trade overlap, shorter exposure to weather delays. For lenders carrying construction loans, these advantages translated directly into lower risk. A construction loan that revolves in 4 to 6 months carries fundamentally different risk than one that sits open for 12 to 14 months. regional banks began developing specific construction loan products for barndominiums. Not case by case exceptions anymore. Actual progress with defined guidelines, documented processes, and repeat underwriting criteria. This was the moment the industry stopped treating barndominiums as an anomaly and started treating them as a category. Phase 4. Construction financing was the first domino. Permanent mortgages were the second. Okay? When Fannie Mae and Freddie Mac began updating their guidelines to accommodate non-traditional construction types, including barndominiums that meet specific standards, the entire game changed. This meant conventional 15 and 30-year mortgages were now potentially available for completed barndominiums. It meant buyers could access competitive interest rates. It meant the secondary mortgage market was opening its doors. And with that, the appraisal problem started solving itself. As more barndominiums were financed, more comparable sales entered the market. As more comparable appeared, appraisals became easier. As appraisals became easier, more lenders were willing to participate. It's a cycle. The exact opposite of the vicious cycle that had kept the industry locked out for a decade. Phase 5. This is where we are right now. And the pace of change is accelerating. Today, barndominium buyers and builders have access to a range of financing products that could have been unthinkable 5 years ago. The lending industry has moved from no to full suite of options designed to serve every stage of the barndominium life cycle. Understanding the available loan products is critical, whether you are a buyer, a builder, or an investor. The financing landscape for barndominiums now mirrors what has existed for traditional homes for decades. That alone tells you how far this has come. Construction-only loans is where it all started. A short-term loan that covers build phase only. Once the home is complete, the borrower refinances into a permanent mortgage. Construction-only loans were the first product that became widely available for barndominiums because they gave lenders the most control. Shorter duration, draws based on completion milestones, and the ability to inspect progress before releasing funds. For builders and developers, this remains a core tool, but it requires a clear exit strategy, which means having a permanent mortgage lined up before the construction loan matures. This is the product that changed the game for individual barndominium buyers. A one-time close. A one-time close loan combines the construction phase and the permanent mortgage into a single transaction. One application, one set of closing costs, and one closing date. The loan starts as a construction draw facility and automatically converts to a permanent fixed rate mortgage once the home is complete. The advantages are significant. The borrower locks in their permanent rate before the construction even begins. There's no risk of rate changes between the construction and the permanent phases. Closing costs are reduced because you only close once. 5 years ago, finding a lender who would offer a one-time close on a barndominium was almost impossible. Today is becoming a standard product, offering at banks across the country, including the big ones. The two-time close. The two-time close gives borrowers more flexibility at the cost of a secondary closing. Here, the construction loan with the permanent mortgages are two separate transactions. The borrower closes on the construction loan first, builds the home, then closes on a separate permanent mortgage once construction is complete. The advantage is optionality. The borrower can shop for the best permanent mortgage terms after the home is built, rather than locking in rates in advance. If rates have dropped during construction, they benefit. If a different lender offers better terms, they can switch. The trade-off is two sets of closing costs and the risk that rates could move against you. But for borrowers who want maximum control over their permanent financing, the two-time close is a powerful tool. Conventional mortgages, and this category matters most for long-term market legitimacy. And when a barndominium qualifies for a conventional mortgage backed by Fannie Mae or Freddie Mac, it enters the same financial ecosystem as every traditional home in America. It can be bundled into mortgage-backed securities. It can be serviced by a major loan servicer. It becomes a standard financial product. The key requirements are straightforward. The barndominium must meet local building codes, have a permanent foundation, be classified as a residential real property, and have adequate comparable sales for appraisal purposes. As more barndominiums are built and sold, the comparable sales requirement becomes easier to satisfy. This is the flywheel effect referenced earlier, okay? Every barndominium that closes makes the next one easier to finance. It's almost perpetual at this point. The USDA rural development loans. This is one of the most underutilized financing tools in the barndominium space. USDA loans offer zero down payment for eligible properties in rural areas. Given that barndominiums are predominantly built in rural and semi-rural markets, the overlap between barndominium buyers and USDA eligibility zones is significant, okay? The income limits and geographic requirements narrow the pool, but for buyers who qualify, this is one of the most favorable financing products available for any home type, let alone barndominiums. FHA loans. FHA acceptance of barndominiums is still evolving, but the trajectory is clear. FHA loans offer low down payment options and more flexible credit requirements. As barndominiums continue to gain acceptance across the lending industry, FHA guidelines are expanding to accommodate them. This matters enormously for market accessibility. FHA loans serve as a massive segment of first-time and moderate income buyers. When FHA fully embraces barndominiums, and it is just a matter of when, not if, it will open the floodgates for an entirely new buyer demographic. Banks are shifting the barndominium lending advantage. Banks are not changing their position on barndominiums because they suddenly became progressive. Banks change when the risk-reward equation demands it, and the equation has shifted dramatically. Shorter construction timelines. Every day a construction loan sits open, the bank carries risk. Weather delays, contractor issues, material price fluctuations, borrower changes, all of these compound over time. So a barndominium that reaches dry in faster than traditional stick-built homes means the lender's capital is exposed for a shorter window. That is not a marginal improvement. It fundamentally changes the risk profile of the loan. Banks are beginning to realize that a construction loan on a well-managed barndominium project may actually carry less risk than a traditional home construction loan. That realization changes everything again. From a collateral perspective, barndominiums offer characteristics that banks should love. Steel siding, steel roofing, resist rots, termites, and many of the degradation factors that diminish traditional home values over time. Lower maintenance requirements means the asset retains its condition longer. For a lender holding a 30-year mortgage, the long-term durability of the collateral is not a small consideration. Insurance companies are recognizing this too. As insurance data accumulates on barndominiums, showing favorable claims history, resistance to storm damage, and lower maintenance costs, the financial case for lending against these structures only strengthens. The comparables sales problem is solving itself. You heard that right. The biggest obstacle to barndominium financing was the appraisal. Without comparable sales, appraisers could not establish value. Without established value, underwriters could not approve loans. So the bottleneck is breaking apart. As thousands of barndominiums have been built, sold, and resold across this country, the database of comparable transactions is expanding rapidly. In many markets, there are now sufficient comparables to support standard appraisal methodology. And as a barndominium tract developments, like what we build at Fortified Capital, create entire neighborhoods of comparable units. The appraisal data becomes even more robust. 20 homes in the same subdivision with similar specifications create a data set that any appraiser can work with confidently. Banks follow demand. They always have. When search volumes for barndominiums has grown exponentially over the past years, when television networks are producing shows about barndominium living, when entire communities of barndominiums are being developed and selling out, the lending industry cannot pretend this is a niche curiosity any longer. The demand signal is too strong to ignore, and banks that refuse to offer barndominium products are watching potential customers walk across the street to lenders who do. In banking, losing customers to competitors is the one thing that moves faster than any committee or policy update. Here's where I'm going to make a statement that some in the industry might push back on today, but will seem obvious in hindsight. Banks will not just accept barndominium financing. Banks will eventually encourage clients to build barndominiums. And here's why. Major regional and national banks will create specific lending programs tailored to barndominiums and post-frame construction, not generic construction loan programs that happen to accept barndominiums. Purpose-built products with streamlined underwriting, specialized appraisal guidelines, and competitive rates designed to capture this growing market segment. We're already seeing early versions of this forward-thinking community banks. The larger institutions will follow. They always do. When banks fully internalize the risk advantages of shorter construction timelines, faster dry-in, and simpler building systems, the logical conclusion is unavoidable. From a pure risk management perspective, a well-structured barndominium construction loan may be preferable to a traditional home construction loan. When that shift happens, and it will, banks will begin actively steering borrowers towards post-frame construction, not because of any ideological reason, but because the numbers work better for the bank. Less time on the books, less construction risk, stronger collateral, faster time to performing permanent loan. The incentives all point in the same direction. Pardon me. As the conventional and USDA channels continue to mature, FHA and VA will fully integrate barndominiums into their standard lending guidelines. This will be the final barrier falling. When FHA and VA loans are routinely available for barndominiums, the entire buyer spectrum will have access. Full-time, first-time buyers, veterans, moderate income families, and rural families. This is not just a financing milestone, it is a housing accessibility milestone. Barndominiums built efficiently at lower cost and financed through a full range of government-backed programs create a pathway to homeownership that the current traditional housing market is failing to provide. For developers like us who build entire neighborhoods of barndominiums, the financing environment is about to become a significant competitive advantage. Banks love repeat business. They love predictable borrowers. They love standardized collateral. Attract a developer who comes to the table with a proven model, consistent build quality, documented timelines, and a track record of completed projects is the ideal lending partner. We will see banks offering preferred terms to established barndominium tract developers, reduced rates, streamlined approvals, portfolio lending arrangements, and dedicated relationship managers. The developers who are building the track record now are the ones who will capture these advantages as the market matures. Prediction number 5. The final stage of this revolution is when banks start marketing barndominium loans the same way they market traditional home loans today. Dedicated landing pages, advertising campaigns, featured products on their website, loan officers who specialize in post-frame construction, And when you see bank running an ad that says dream home built different, ask about our Barndominium mortgage packages, you will know the revolution is complete. And I believe we will see that within the next 5 to 7 years. If you are an investor watching the Barndominium space, the financing revolution is the single most important tailwind you should be tracking. Financing availability does not just affect whether homes get built, it affects who can buy them. It affects resale value. It affects exit strategies. It affects every financial metric that matters. And when a barndominium can be financed the same way as a traditional home, it competes on a level playing field. And on a level playing field, the advantages of post-frame construction, faster builds, durable materials, efficient systems become pure upside. The operators who are positioned in this space now will, with vertically integrated construction operators and established banking relationships, are the ones who will capture the full value of this shift. At Fortified Capital, this is exactly what we have built. Not because we predicted this financing revolution, because we built through it. Every banking relationship, every completed project, every refinance, every appraisal. They all contributed to proving the model that the broader industry is now adopting. We did not wait for the industry to come around. We helped bring it around. The Barndominium financing revolution is not something that might happen. It is happening. But right now, every month, new lenders enter the space. Every quarter, guidelines expand. Every year, the data gets stronger. The comparables get deeper and the risk profiles get more favorable. The trajectory is clear. We are moving from an era where banks said, absolutely not, to an era where banks will be saying, how can we help you build? The only question is whether you are positioned to benefit from that shift, or whether you are still waiting for permission.